Apple just keeps rolling along. The company dominates the mobile computing business with its iPhone and iPad lines. It earns the lion's share of profits in the computer industry with its line of Macintosh computers. It has rapidly growing businesses with the sale and services of related software, accessories, and networking equipment. And it provides third-party digital content across movies and music. Apple's success over the last 15 years is legendary, as are its investment returns. From a low of $1 a share in 2003, the stock has risen 200 times to its recent current price above 200, a 20,000% investment return. In fact, Apple was the first company to reach a total equity market value of $1 trillion. As outstanding as that total return performance and business performance have been, in recent years, some room for doubt has managed to creep in. Over the last 5 years, for instance, Apple's performance relative to the S&P 500 has plateaued. Its returns have about equaled the returns which an investor could get owning an index fund keyed to the S&P 500. Because the overall market had such lofty returns, Apple's absolute returns have still been pretty satisfactory, but the fact is there is some doubt as to whether the company is now too big really to continue to outperform. So looking forward, the question for Apple investors is whether its relative performance will follow path A and again outperform the overall market, follow path B, in which it becomes a market stock, providing returns in line with the market, or follow path C, where its returns lag the market. Will Apple be a leader or a laggard? Let's address that question. For our analysis of Apple, we've selected a peer group that contains some obvious choices like Microsoft, Intel, NVIDIA, but some less obvious choices like Alphabet, Alibaba, and Disney, which, while they're not straight technology companies, given Apple's increasing spread across various businesses, they are really, in fact, competition. To look at Apple, let's start with a look at its investment characteristics. These are 12 investment factors that, taken together and analyzed, can help define a company's investment personality. The upper end of the bar is upper quartile, the middle of the bar is median, lower end of the bar is lower quartile for, in this case, the S&P 500. The red dot is Apple. So these characteristics are arranged into 4 groups: valuation related, growth, profitability, and risk. And what we like to do is find those factors where a company is in either the upper or lower quartile, because those are the factors then that begin to give it its hard edge, its investment personality, if you will. So on that basis, if we look at places where Apple is upper or lower quartile, you'll see that on a valuation basis, its its price book ratio is quite high. On a growth basis, expected and historical growth is neither high or low, but the company has been very consistent, so its earnings variability is quite low. In terms of profitability, it's stellar. Both historical and forecasted profitability are way into the upper quartile. In terms of risk, the stock has been quite volatile. In fact, its beta, or volatility relative to the market, is upper quartile. And finally, with its mammoth gargantuan market cap, size is usually taken as an example of stability and low risk. Apple gets a mark there. So, very profitable company, but interestingly, this analysis would lead you to begin to look at growth as being an issue. In terms of profitability, we look at six different ways, or 6 factors that, taken together, define a company's return on equity, which PriceTarget Research views as kind of the principal value driver. And looking in particular at return on equity, you can see the significant improvement in profitability that has happened over the last 10 years or so, with return on equity rising to its current level in the high 40s, which is virtually unheard of, a company of this size to be that profitable. If we look at growth, these are 4 measures of growth, all on a per share basis. Revenue per share, earnings per share, assets, total assets per share, and common equity per share. You'll notice that the growth rates over the whole period have been pretty consistently in the high 20%. But you'll notice that there have begun to be some questions about plateauing. While earnings per share have grown 28% over the last 10 years or so, over the last 5, they've only grown 11.5%. And equity per share has really slowed too. It's down into the single digits. So as we look at our growth rate projections, you'll notice here that the consensus growth rate is significantly below the company's historical growth rates. Our forecast, PriceTarget Research's forecast, is even below that. We don't think Apple is going to grow at more than 5 or 6% per year. Interestingly, on that point, let's spend a minute on cash flow. Look at one of the other analytics that PriceTarget Research utilizes. This chart shows the company's EBITDA for 2017, and then a variety of other factors that were either sources or uses that led then to the change in the company's cash balance. Focus on what happened last year in terms of investors, both debt and equity. You'll see here that debt investors provided a significant chunk of additional cash to the company, whereas equity investors withdrew significant amount of cash in the form of both stock buyback and dividends. Typically, with rapidly growing companies, equity investors are not withdrawing large amounts of capital. So this is, again, another element in the question as to Apple's growth rate going forward. It really reflects a leveraging up, if you will, where the company has become much more of a borrower than it used to be years ago. So our forecast for Apple, return on equity, you'll see here, volatile but increasing. We think it's likely to be maintained in the current 40% plus range. The cost of capital, equity capital for the company below, an enormous spread. Wealth creators earn significantly higher returns than the cost of capital. In Apple's case, almost a 40% spread, and that's a key value driver. The other important input to Apple's valuation is its expected growth rate. And as you can see from the chart, we continue to think that Apple's growth rate is going to trend down towards 6%. Largely reflecting the fact that at its size, it's increasingly difficult to grow at the double-digit rates it did earlier in this decade. So a 6% growth rate is where we come out on expected growth. When you look here at the warranted value of the company, we think that it's likely to be worth in the high $200s a share in the next several years. And when we combine the profitability that we expect with the company's power rating, which is a measure of timeliness, and its appreciation score, which measures how attractive the company is relative to its price target, Apple earns our highest grade of A at this point, at the end of October of 2018. And you can see here we've had the stock buy rated basically since the beginning of 2017. You'll see that it became a B-rated stock toward the end of 2016 and has been either A or B since. So the answer to the question from PriceTarget Research's perspective, whether this stock will be a leader or a laggard, is that it will definitely be a leader. There are 6 keys then to thinking about Apple looking forward. They are that it is the highest quality and lowest risk. It has a major deceleration in expected growth likely to happen, but it's going to maintain its superior profitability. It has significant future cash flow being produced. While wealth creation chained to that cash flow creation is slowing, it's still significant. Its timeliness is very positive, and the current value trend rating is A. So the answer to the question is Apple is a leader going forward. Until next time, you can visit us on the web at PriceTargetResearch.com, where you'll find very broad coverage of companies, comprehensive research and ratings, and relentless updates and alerts. You can also find more of our videos on YouTube at YouTube/PriceTarget Research. And you can also find us on Twitter at twitter.com/PRC Target. That's it until the next research brief.